Markets are down and a little on the flat side today after fears of Pelosi landing in Taiwan, China responding, and the Fed clarifying Powell's remarks the other day. Everybody's coming out, walking it back, saying that they need to continue to get inflation down. They are not going to pivot. They're not saying those exact words in terms of pivot, but basically they're saying we see interest rate hikes in September and beyond. We've got to get inflation under control until we see inflation plateau and start to move backwards and stability in the jobs market. They are not going to make a move and they're not going to pivot and start easing again, especially without a significant contraction in the jobs market. So there's still a long way to go. And the market just got ahead of itself yesterday and the day before off of the Fed news last week and yesterday. So today, Dow Jones down about 1.2, S&P down 0.67, NASDAQ kind of flat on Uber. Uber beat earnings and shot up about 20-25%, but it beat on revenue, but not earnings. It didn't make any money, but it beat on revenue. So the market went nuts on that. That's kind of funny that just because they beat on revenues, but did not make any money, the market liked that and the stock went through the roof. And then that will unwind once they realize, wait a minute, the company has no earnings. So it doesn't matter how much money you take in. If you're not making any money, that's unsustainable in this climate. Zero earnings companies are the ones that have taken the biggest hit in NASDAQ. So it'll be interesting to see how that works out, how long it takes for that to unwind. The big issue of the day are the tensions and the fears in China. China is currently surrounding Taiwan and setting up what looks like they're calling it military drills, the exact same move and talk and positioning that Russia did before they invaded Ukraine. So we'll just have to wait and see what that looks like. And if China, after Pelosi and the Americans, the United States diplomatic team leaves Taiwan, if they're going to actually make a move and start their invasion. But they are surrounding the island. They're setting up their forces for what looks like a strike. But we'll just have to wait and see. It's not as imminent looking as Russia, as they had been building up troops for months and months and months in advance of the Ukraine invasion. But we'll see. China is a bit of a loose cannon. So if they do invade, you can expect serious contraction in the markets, just like we saw with Ukraine. Big sell-offs, probably limit downs and circuit breaker trips and things like that. Especially if there's potential that creates conflict with the United States, or that they somehow align with Russia and the United States and NATO get dragged into a larger conflict, and then you have escalation. But anyway, stocks slumped today as investors weighed increased tensions between the U.S. and China and House Speaker Nancy Pelosi's visit. So all eyes are on that. And then the big news is the Fed. Chicago Fed President Charles Evans said that he hopes the central bank can raise its benchmark interest rate by 0.5 percentage point in September, and then continue with quarter-point rate hikes until the start of the second quarter in 2023. Later, so he said he hopes they can raise it by 50 basis points as opposed to 75, but he said 75 is not off the table, but they hope that they can do less of a hike, but they definitely see that 75 could be reasonable. Definitely not talking about 100. Later, Loretta Mester, president of the Cleveland Fed, said that several more months of evidence that inflation has peaked will be needed before the central bank ends its rate hike pivot. So they're going to need a lot more stable news for inflation and recession concerns before they even think about stopping, much less pivoting. So we will have to see how all of this plays out. We get our next inflation print next week on the 10th of August. So we will see what July inflation looks like. A lot of people think that inflation has come down, that it has plateaued. But again, that's July numbers that we're going to see in August. So I don't think gas prices came down far enough, fast enough for that to really impact inflation read and print. I still expect 9%, but I could be wrong. We will see what happens. Here's a big news today. MicroStrategy is going to do a earnings webinar to discuss their earnings and their Bitcoin strategy. Michael Saylor is stepping down as CEO, and his previous president of the company, Phong Le, will take over the reins. Michael Saylor says he's leaving his role as CEO to become executive chairman of the company, and he wants to focus his attention 100% on Bitcoin. He says, I believe that splitting the roles of chairman and CEO, he becomes chairman, the other guy is full-time CEO, will enable them to better pursue their corporate strategies of acquiring and holding Bitcoin and growing their enterprise analytics software business. As executive chairman, I will be able to focus more on our Bitcoin acquisition strategy and related Bitcoin advocacy initiatives, while Phong will be empowered as CEO to manage overall operations. So that'll be interesting to hear from them after hours, what their earnings look like, what their the Bitcoin purchases have looked like, and what their plans are for the future. That will be a webinar. You can go to MicroStrategy's website to find the link and join that and listen in if you're interested. So that'll be fun news coming out of that, and we'll just see how the stock responds to all that. This is Bitcoin on the hourly, continuing its little trek with, on the hourly, higher lows and higher highs. When you look at this on the 4-hour for this little range right here, same thing, higher highs, higher lows. But at the end of the day, these are all still higher, lower highs and higher, lower, and lower, higher lows, or higher, lower lows. So, this range, we're getting higher highs and higher lows, but in the overall trend, everything is still lower until you start taking out these last lower highs and lower lows. And that's really what you need to see, a reversal. But this is all just an exaggerated setup from where we've been. So all, by all accounts and expectations of where we've been, this is just another step and another consolidation for a range down, like we've been talking about. The next little area of support is going to be right in here. Once it breaks through this area, it's going to be right over in here, where you have about, $15,500, $16,000, where price could get some support and get kind of hung up in this region right in here. Let's see, right down in this area here. And then after that, it obviously drops down to that 12 to 15. So the next level down, if price breaks that low that was just put in back in June, on the 18th of June at 17,600. If that breaks, then you're looking at 16 and a half, 15 and a half, somewhere in there, potentially all the way down into the 12s, especially if you get an invasion of Taiwan by China and escalations potentially in other areas. Russia's obviously talking tough and trying to drag the United States as culpable into the war in Ukraine. Could be for a number of reasons why they're doing that, but we'll see how these things go. So anyways, between that 12 and 17 could be a range that Bitcoin could hover in for a while and ultimately put in the macro low for this cycle, unless something really crazy happens. It's unlikely that this range here between 17 and 24 is going to be the ultimate long range bottom, but it could be. There's no way to know for sure until we get there. Nobody knows exactly for sure what's going to happen. All you can do is just look at the current global macroeconomic climate, because all things macro are affecting things right now. The price is still wrestling, Bitcoin still wrestling with this 200-week moving average. And then if we go look at the markets, markets are finding resistance and, below that 50-week moving average, but have not touched the 100-week moving average yet in traditional markets. Let's go ahead and look at them on the daily. And markets right now, this is the S&P is finding a little bit of resistance at the 50-day moving average. NASDAQ, same thing, wrestling with the 50-day. Dow Jones, the 100-day moving average, wrestling with that. So trying to keep and take the 100-day moving average. So the question is, what's next in traditional markets? And again, just this rolling over of markets, we kind of looked at it the other day in terms of what these markets look like and how they operate, and how long some of these things can take. Even in the pandemic, as the market was climbing to its peak before the pandemic, even this drop from peak to trough in the pandemic, that was fast, but it still took 27 days. And then in order to get back to previous all-time highs, that was with, all of the money pumped in the economy, that still took around, see, about right in this area here, that still took about 190 days. Not too bad, 6 months. But if you go back and look at previous cycles, again, this is all the Fed pivot right here, or the Fed, infusion of trillions of dollars right here. Neil Kashkari coming out saying we have unlimited funds to support and prop up the markets, and our ability to do so is infinite. And the last time the Fed pulled back was over here in 2018 in this area here, when the Fed contracted and then they pivoted and we got a V bottom out of that. But the Fed started pulling the plug on the markets back here in 2018. And that was a 2-month process there of the markets declining. So this, as you can see, is a longer, much more protracted decline. And from the peak in the Dow, this is the Dow we're looking at, to the trough was about 115 days. So not quite 6 months, but 3 or 4 months that we've been in this rollover process. And if you look at bear markets in the past, let's take a look at this on the weekly that we looked at. These things can take some time. So this was the 2001.com to 2003 bottom, and it took several years for that to roll over and reach bottom. And then it took several years for the market to get back to even. Then we had a new all-time high put in prior to the 2009 collapse. Took several months to get to the bottom there once the market started rolling over. And then, of course, it took several years to get back there. And the interesting thing is, a lot of people are thinking that we're going to see some sort of recovery like this over here, but this was a very different time with trillions of dollars being pumped in the market, whereas this is probably what's more likely. And this was without a Fed coming into the market doing quantitative easing and stimulus, or quantitative easing and low interest rates, zero interest rates, things like that. That started in 2009. That's when the quantitative easing started, artificially low interest rates, and trillions of dollars pumped in. And then, of course, right here, this last little spike was that 2 trillion pumped in basically 18 months from March 2020 until January of 2022. And so to expect anything like this or anything like this to occur without the Fed pumping the markets up with trillions of dollars, zero interest rates, a complete 180-degree turn, and then, of course, stimulus pumped in by retail and things like that in this area, is just not a realistic expectation, and it's just not in the cards. So the probabilities, what's realistic, is, if anything, sideways consolidation like these markets will do after a big sell-off. So if you go back to 2009, this is the .com for the NASDAQ, you get these sideways consolidations for a number of years before the markets back off to the races. And then 2009 was another bottom, sideways to up consolidation for a while, and then off to the races after the Fed got involved. So these things take time to work out. This is not something that potentially could happen overnight. It's just not how markets work, even with tremendous Fed intervention, QE, zero interest rates. It still takes markets a while to recover. So this isn't going to turn around overnight. What these markets, what crypto takes, and stock markets, it takes new capital, new investors, new money coming in to prop the price up. I mean, that's just what it takes. That's what it's all about. And a lot of people got in over here, have lost a lot of money. And then, of course, with Celsius and all these other things happening, a lot of people have been chased out of the space and just have lost so much. It's going to take a while to get new investors, new capital back into the space. And the longer this goes on, and the higher inflation gets and recession and things like that, people have less interest in super risky speculative assets like this. And the more people lose in these chopped up environments, the less they have to be able to return to the space anytime soon. So it's going to take time to work this out, get new investors to come in as the markets stabilize. And this is all assets, right? This is stocks, especially stocks are risk assets, just like crypto. Crypto is just more exponential than stocks. Ethereum, a lot of attention on Ethereum with the merge coming up, but I think this might be a sell the news event when the merge happens, if it happens. I don't think the fees are going to be reduced. I don't think there's going to be a whole lot of major changes, potentially some hiccups along the way, but this is obviously just the pump ahead of the news there. So just be careful with that. And, you can anticipate a little sell-off there on the news, like happens a lot of times with these types of events, as the markets continue to work themselves out and get to the point to where inflation gets under control, recession fears are off the table, global conflict is out of the picture, markets can reset, reboot, and we'll be back off to the races again in the bull market. And I'm looking forward to those days. But until then, we have to navigate safely. We have to be cautious. We have to manage our risk and just be aware of what can happen, because this is a very different economic environment. A lot of people have never been through anything like this before, never been through a recession, never been through a bear market, never been through inflation like we're seeing it and all the things, with global conflict, things like that. So things don't always go up forever. And bull markets don't always last forever. And this is just a natural order of things. It's the business cycle of the markets. It's a global macroeconomic business cycle, peaks and valleys. And that's just kind of what we're in right now. So it takes time. These things take time. Without the Fed pumping it up, propping it up, and pivoting, which they cannot do, and they've said repeatedly over and over, they will not do until inflation is under control. And it's going to take a long time for inflation to get under control, at least 6 months before you see any kind of a dip, and possibly a year or more, could be 18 months to 2 years before they get anywhere near 4%, much less 2%, which is what they're targeting, where they can actually get back in and intervene and do some things. And a lot of stuff can break in the meantime that can cause big knee-jerk reactions in the market. So these are the things I'm looking at, and this is all just cautiously optimistic. Good times never last, bad times never last. But fortunately, we have more longer good times than bad times. If you look at the charts, the bull markets last a lot longer than the bear market. So once we get through this, we'll be back off to the races. It'll be bull market on. And those are much more fun, much easier times to navigate. So that's what I'm looking at, and I'll see you in the next video.